It's a fairly fundamental concept for accountants that the business that we are reporting on is a separate entity as far as we're concerned for management reporting purposes to the person who owns that business. Now, that will be a different story compared with what a lot of lawyers would say, which is if somebody's a sole trader, so they run a business on their own, the business has never been set up formally to be a separate legal identity. Legally, there is no distinction between that person's business assets and their personal assets. As far as we're concerned as accountants, there really is. Because of the fact, if somebody is a sole trader, imagine they're a self-employed builder, for example, then any expenses they have to do with their job, like buying materials, are clearly an expense that will help us work out whether they're making a profit or loss. If they have personal expenses, like going on holiday, that's got nothing to do with the business at all. So, although lawyers may actually have a different view of this because of the fact that they have separate identity concepts which you look at in paper F4, as accountants, we're far, far, far more about the true and fair view, which is that if something's a business transaction, we treat it as if it were in a legally separate business, even if it's not. There is kind of like a big line there, and that's also going to be used by the tax authority, a big line between the personal transactions of the owner and the business transactions of the owner. Now, in practice, for smaller business owners in particular, that line tends to become somewhat blurred because of the fact that quite often they'll have cash that they're working with during the day to buy some materials, and their own cash and the business cash kind of get mixed up a little bit. So this is practical. A practical point that you end up having to actually keep very, very careful records of how the two things are kept separate. If they're not, then that becomes quite difficult in practice. In theory, though, they really ought to be kept entirely separate. What most even fairly small businesses will do is that small business owners will do, at a minimum, is they're likely to have a business bank account and a personal bank account. I think people instinctively understand the difference between the two. Now, there are three different types of business entity that you need to be aware of in the paper F3 exam. Let's look first of all at sole trader. The number of investors in a sole trader's business, well, is that person himself or herself. In other words, the sole trader, so there is only one person. And this is where you're most likely, in a practical point, to have kind of confusion between personal transactions and business transactions. So, for example, if somebody puts through their business accounts, basically every time they go shopping for food, that really isn't a business expense. The tax authority aren't going to have you submit that as a business expense, so your accounting system needs to keep it separate. Okay, you need to produce accounts to the tax authority for sure. It depends where you are in the world, but that person is going to need to know what profit they've made on business income less legitimate business expenses. They, generally speaking, don't actually have to file accounts with the company registrar. Depending where you are in the world, the business name tends to just be that person's name. Sometimes it might be that they have this kind of thing of trading as, let's say, on the business bank account. So it might have the person's own name, followed by trading as a Bob the Builder. So they might be, kind of Robert Smith, trading as Bob the Builder. That means Bob the Builder's business, transactions called that, are going to go through the accounts for the business. Any transactions for Robert Smith's own business are not going to go through those accounts. Now, this person can't offer shares to the public because there are no shares in the business because it's a simple, sole trader business. And in other words, the shares aren't broken into shares as such. The business isn't shared between any two people, hence no shares. So the equity part of the statement of financial position is the business equation, really. It's initial capital plus cumulative profit less cumulative withdrawals. In other words, the capital that has been put in to the business, and that might have been included, that might have been increased plus any subsequent capital. Normally it's just the initial capital, but if this person's put more cash in, it's basically the subsequent capital as well, the total amount they've invested in the business, plus the cumulative profit or cumulative total comprehensive income these days, less the cumulative withdrawals. In other words, basically, that's called retained profit by most people, but we show it as two separate components in the statement of financial position of a sole trader. In other words, it explains where that sole trader's business net assets came from. Let's take a look at a partnership. Partnerships are basically collections of sole traders. Now, they can vary quite a lot in legal form around the world, but the accounting is much the same. Using UK law, normally a partnership is limited to about 20 co-owners, about 20 partners. That's slightly different, by the way, for partnerships of lawyers and accounting firms, where that limit doesn't exist. But for most businesses, it's about 20. They do have to produce accounts to the tax authority. The question whether they have to file accounts with the company registrar depends on the form of the partnership in the world. Often the answer is no, you don't. And the reason is because often partners have unlimited liability for the debts of the business. A sole trader, by the way, although as accountants we consider them to be a separate entity, legally there's no distinction between the two. So if a sole trader runs up large debts, then they are personally liable for those debts. They don't have any limited liability for business debts. And the same is true in simple partnerships. The business name has no formalities. It's often the name of the original partners, that's it, and they can't offer shares to the public. The bottom half of the statement of financial position, the equity section, is conventionally split between two things that we look at when we look at partnership accounting, which is each partner's capital account. That's the amount that they paid in, probably when they first became a partner, and then the current account, which is the retained profits available to that partner. In other words, their share of profits that they've made, less the amount they've taken out as cumulative withdrawals. So in effect, that basically is, for a sole trader, just cumulative profit less cumulative withdrawals, one figure. If you've got a partnership with maybe 20 partners, the bottom half of the statement of financial position looks very complicated because you'd have to list the accounts of capital and current account for each one of those 20 partners. So actually the balance sheet, the statement of financial position, would mostly be the equity section. Let's take a look at a limited company. Limited companies have a particular meaning. A limited company, just as a little point of interest here, doesn't mean that the company has limited liability for its debts. A company can be sued out of existence for its debts. The limited liability kicks in, where you're looking at the liability of the shareholders to the business itself. If you're a shareholder in a limited liability company, what it means is that your liability to the business is limited to the amount you put in as the share capital. Now that's a point that comes up in paper F4, but it's just a useful thing, I think, to say up front, that limited liability does not mean that the company has limited liability. I know it's counterintuitive, it's surprising to a lot of people. A limited company has unlimited liability. The limited liability is that you as a shareholder, your exposure, your risk is limited to the amount that you put in when you bought your shares. A limited company, again, varies around the world. Some countries it's a minimum of 2, sometimes even a bit more. In UK law, which I think is what the question will be based around, really, it's basically going to have a minimum of 1 person, but an unlimited large number of shareholders. Some companies have an absolutely huge number of shareholders. They do have to produce accounts to the tax authority. Often they have corporate tax, whereas in the case of a partnership or a sole trader, these here are generally personal income tax. So the basis is completely different. You will only see tax as an expense in paper F3 in the statement of comprehensive income if it's a limited company. Certainly they're going to have to file accounts as a limited company. Very, very likely have to file accounts with the commercial register or the company's house, whatever you want to call them. The business name, there are often restrictions on this so that people know that there is anybody lending money to a limited company knows that there isn't a sort of bottomless pit of easily available funds there. The name often has to finish with limited, if it's a private limited company, or PLC or something, if it's a public limited company. Now that varies where you are around the world. So for example, in Australia, a private limited company has to finish limited PTY, which means proprietary, in other words, private limited company. Now again, the formalities change depending where you are in the world. Of course, the language changes, but the actual the pattern is pretty stable. The equity section of the statement of financial position, the equity statement of the part of the statement of financial position for all of these explains where the net assets came from. That's what equity does. It explains where the net assets kind of came from, where they originated from, how they got there. Well, the share capital shows the amount that shareholders paid to get into the business in the first place, and then we have reserves. Reserves are basically retained gains. People often are confused between the difference between a reserve and a provision. The answer is they are nothing at all similar to each other whatsoever. A provision is a liability, we'll see that later. A reserve is a retained profit, a retained gain of some form. So for example, the profits that the business has made, less the dividends that they paid, are what's called retained earnings. If you have any gains that have been taken directly to equity, like a revaluation on property, that goes to a revaluation reserve. You're increasing the net assets in the top of the balance sheet, statement of financial position, so therefore you have to increase the figure in the bottom half as well. Otherwise, your balance sheet does not balance. And that's a undesirable characteristic of the balance sheet. Okay, now this stuff is just worth having an understanding of before we look at the detail of how we account for these different business types. I would suggest that in the exam, the most important one is sole trader.